Have you ever felt like tax season is less about simply reporting what did happen and, well, more about navigating this dynamic, almost living set of rules that just constantly shifts under your feet? It's like, your carefully constructed financial plan just got sort of upended by some surprise shift in tax legislation, and suddenly yesterday's smart move is today's missed opportunity. That feeling, that core challenge of adapting to change is exactly what we're taking a deep dive into today because it's not just about what you earn or spend. It's crucially about when the IRS considers that income to have been earned or maybe that expense to have been incurred. We're talking about understanding how monumental shifts in tax laws and rates, like, say, those brought about by the Tax Cuts and Jobs Act, the TCJA, how they can impact the very timing of your income and expenses. This distinction, this power of timing, it's arguably one of the most underutilized levers in strategic financial planning.
That's precisely it. Today, our mission is to really peel back the layers and explore the powerful tools available. Tools for businesses, for individuals, to strategically manage this timing. We'll be unraveling the intricacies of IRS Form 3115, which you might know as the Application for Change in Accounting Method, and we'll connect it directly to key provisions of the TCJA. Our goal is to show you how these, well, seemingly technical elements don't just intertwine. They actually create opportunities for some pretty sophisticated planning, ultimately giving you a distinct advantage in, a fluctuating tax landscape.
Yeah, our mission here is clear. We want to provide you with a clearer roadmap, something packed with maybe surprising facts and practical insights, so you can feel truly well informed and empowered to make smarter tax planning decisions. Think of it as your shortcut, maybe, to understanding how these nuanced tax rules can translate into real-world cash flow benefits and strategic growth. Okay, let's unpack this. We're starting with the fundamental concept that kind of underpins all of this strategic timing. What is an accounting method? For those of you already familiar with tax concepts, you know this isn't just basic bookkeeping. It's essentially the set of rules you apply. Rules to determine the moment income is recognized as earned and the moment an expense is recognized as incurred for tax purposes. It's not merely a historical record, it's a critical lever for influencing your current and future tax liability. It dictates the very rhythm of your financial year from a tax perspective.
And what's truly fascinating here is the sheer power that timing, driven by your accounting method, wields over your taxable income from one year to the next. Let's consider a practical scenario. Imagine a fast-growing tech startup. They just completed a massive software development project for a client in December. They've incurred significant development costs, let's say $500,000, and they're set to receive a $1 million payment. Now, if this startup operates under the cash method of accounting, which is generally simpler, right, that $1 million payment only counts as income when it's actually received.
Okay, cash in hand.
Exactly. So if the client pays them on January 5th of the next year, that $1 million income shifts entirely into the next tax year. Similarly, their $500,000 in development expenses are deductible only when they're actually paid. So if they paid their developers and suppliers back in December, those expenses would fall into the current year. The key takeaway for the cash method is really that cash flow dictates the timing of income and deductions.
Right. Makes sense. But what's the alternative?
Well, the main alternative is the accrual method. Under accrual, income's recognized when it's earned, regardless of when the cash changes hands. So for our tech startup, that $1 million payment, it was earned when the project was completed in December. So it would be recognized as income in the current tax year, even if the cash doesn't actually arrive until January.
Ah, okay. So it's tied to the completion of the work.
Precisely. And expenses are recognized when they're incurred when the liability rises, not necessarily when paid. So that $500,000 in development costs, they'd be deducted in December when those services were used or the liabilities were established.
And this timing, this difference between cash and accrual, it becomes even more critical when tax rates might change, right?
Oh, absolutely. It becomes an act of strategic choice. Let's say our startup's founders anticipate that corporate tax rates are likely to drop significantly next year. Under the accrual method, they might be bringing that $1 million income into a higher tax year. Not ideal. But if they could somehow shift to the cash method, maybe they could defer that income into the lower tax year.
Wow.
That could potentially save them hundreds of thousands of dollars in taxes.
That's significant.
It is. Conversely, if they anticipate rising tax rates, they want to do the opposite. Accelerate income into the current lower tax year, maybe defer expenses into the higher tax year to get a bigger deduction bang for their buck. This isn't just about saving money in the short term. It's about optimizing cash flow, maximizing the post-tax value of every dollar. And that directly fuels a company's growth and reinvestment capabilities.
So It really sounds like we're talking about fundamental shifts here, not just, minor tweaks to your books. This isn't just filling out forms. It's about making active, strategic choices with very real financial impacts. What then is maybe the biggest misconception people have about changing an accounting method? And how does the IRS view these changes? Because to actually make these changes, you need a key, right? And that key to unlock a change in your accounting method is IRS Form 315 Time. This isn't just any government form, it's the official request you make to the IRS to change how you account for something. It's your formal way of saying, hey, IRS, we're shifting our timing on this, or maybe on our entire financial picture, and here's how and why.
Well, a really common misconception is that changing an accounting method is something you can just decide to do internally, just flip a switch. But in reality, the IRS views accounting methods as fundamental to accurately reflecting income year over year. So you can't just unilaterally switch. You generally need their permission. And that's precisely what Form 3115 is for. It brings structure and oversight to what could otherwise be a chaotic and frankly inconsistent reporting environment.
Well,
And the scope of changes that Form 3115 covers is actually quite broad. It offers significant flexibility once you understand the rules.
okay, so what kinds of changes are we talking about? Big picture stuff or just specifics?
Both, actually. It can be used for an overall accounting method change. That's a big one. This would be a comprehensive shift, for example, from the cash method to the accrual method for your entire business, or maybe vice versa. This impacts nearly every income and expense item on your books. Imagine, say, a small consulting firm that has scaled up rapidly. Now they have significant deferred revenue from long-term contracts. Moving from cash to accrual might be essential for accurately reflecting their financial performance, and Form 3115 is the gateway to doing that properly.
But it's not just the whole shebang. You can change smaller things too.
Exactly. Form 3115 also covers changes for specific items. This is really powerful. It means you can request changes for particular types of income or expenses. Think about how you handle depreciation on assets. Do you write off the cost quickly using bonus depreciation or spread it out over many years using MACRS?
Right, classic timing decision.
Or consider repair costs versus capitalization. If you replace an engine in a company truck, is that a repair you deduct immediately? Or is it an improvement you add to the truck's basis and depreciate over its useful life? Form 311 lets you change how you treat these specific items. And many others, too, like advance payments you receive from customers for future services, or how you value your inventory. Even a seemingly small change, like how you expense small tools instead of capitalizing them, can have a really substantial cumulative tax effect over time. It can lead to significant immediate deductions.
So it's not just fixing mistakes then.
That's a crucial distinction, yes. And a key insight. These changes are generally not simply correcting an error you might have made in the past, like, say, miscalculating a depreciation amount 1 year. Instead, they are fundamental shifts in how a taxpayer measures income and deductions going forward. They directly impact your current and future tax planning strategies. It's really about optimizing your financial flow through the tax system, not just fixing a past mistake.
And for you, our listener, who wants to gain knowledge quickly and apply it effectively, well, this deep dive is designed to give you that shortcut, a shortcut to understanding how these changes can truly benefit your tax planning. Knowing these levers are available is the first step. Understanding how to strategically pull them is where the real power lies for your business or your individual finances.
Exactly. And what's fascinating here is that the IRS recognizes the necessity of these changes. They've actually streamlined the process through two primary pathways for filing Form 3115, making certain common changes much more accessible.
Two pathways. Okay, what are they?
The first and generally simpler route is the automatic change procedures. This is by far the more common pathway for method changes, especially for well-defined scenarios. You're typically eligible for an automatic change if the specific change you want to make is described in published IRS guidance. Think of a revenue procedure as the IRS's detailed instruction manual for specific tax actions. It lays out the exact steps and requirements. A key resource here is Revenue Procedure 2022-14. It lists many designated automatic accounting method change numbers, or DCNs.
CCNs, okay.
Right. These DCNs essentially provide a menu of pre-approved changes that, if you meet the conditions, are generally granted upon timely filing.
And the benefit of automatic sounds like it's easier.
It is, and crucially, the significant benefit is that there's no user fee required for automatic changes.
No fee. That's huge.
Absolutely. It dramatically lowers the cost barrier for making common, beneficial changes. Consent to make the change is generally granted upon timely filing and compliance with the specified procedures. It's subject only to review by the IRS National Office later, but the approval is largely automatic upfront. This streamlines the process considerably and provides a much higher degree of certainty that your requested change will be approved, which is, a huge benefit for planning. Ordinarily, you're required to file a separate Form 3115 for each accounting method change you want to make. However, there are exceptions. Published guidance, like Section 6.03 of Rev. Pro. 2015-13, allows for a single form to be filed for specific concurrent accounting method changes, essentially bundling related changes together. This automatic route is where you find those opportunities for standardized tax benefits and efficiency, especially for common adjustments like changes in depreciation or repair methods that affect many, many businesses.
Okay, so the IRS makes it easy and free for common changes. That makes sense. But what if your situation is unique? What if it's not on that menu of DCNs?
That's where the second pathway comes in. If your desired change doesn't fall under the automatic procedures, you might need to pursue the non-automatic change procedures.
Non-automatic sounds more involved.
It is. This is the more complex route, essentially for bespoke situations, where your desired accounting method change is maybe so unique or tailored to your specific business model that it hasn't been codified into an automatic procedure. It's like asking for a custom suit rather than buying one off the rack.
And I'm guessing custom means more expensive.
You guessed it. The main drawback here is that this path requires a user fee. These fees are designed to cover the IRS's resources for providing a formal letter ruling tailored to your specific request. You'll want to check Appendix A of Revenue Procedure 2023-1 for the schedule of these fees. They can range from a few $1,000s to significantly more, depending on your entity size and the complexity of the request.
Okay, so there's a cost. What's the process like?
It involves requesting approval directly from the IRS National Office. And if approved, you'll receive a formal letter ruling specifically granting your change. Generally, a separate Form 3152 and a separate user fee are needed for each unrelated item or submethod being changed. For example, if you're a single taxpayer, but you have 3 separate and distinct trades or businesses, and you want to implement an identical non-automatic accounting method change for all 3, maybe changing how you account for research expenses in each day, you generally need to pay 3 user fees, 1 regular fee, and 2 reduced fees for the additional applicants.
Ouch. Multiple fees even for the same change in different parts of the business.
Yes. The same applies to a common parent of a consolidated group filing for multiple members. Each member changing the method might trigger a fee.
So this raises an important question. Why would anyone choose this more complex, fee-laden path?
That's the calculation, isn't it? Because the potential tax benefits from a unique accounting method change, one that isn't covered by automatic procedures, could significantly outweigh the fees and the complexity. It's a calculated risk, really, for potentially larger rewards, especially for highly specific, high-value transactions or maybe business models that just don't fit the standard molds.
Okay, so we have these 2 paths, automatic and non-automatic. But who actually walks these paths and who benefits? That brings us to a distinction you mentioned.
Right.
The filer versus the applicant. Can you clarify that for us? It sounds a bit technical.
It can seem that way, but it's important. The filer is simply the entity or person who is required to submit the Form 3115. This could be, say, a common parent corporation filing on behalf of a consolidated group, or maybe just an individual business owner filing for their sole proprietorship. The applicant, on the other hand, is the entity, the person, or even a separate and distinct or business of an entity whose accounting method is actually being changed.
Okay. So the filer submits it, the applicant is the one whose method changes.
Exactly. So, in our example, if the common parent files for another member of the consolidated group, the common parent is the filer, and that other member is the applicant. This distinction matters because, as we just discussed with non-automatic changes, a separate Form 31 fee and user fee generally apply for each applicant and each separate trade or business. This includes entities like a qualified subchapter S subsidiary, a Q-sub, or a single-member limited liability company, an LLC, that's treated as a disregarded entity for tax purposes. It's also relevant for a broad range of structures: consolidated groups, S corporations, partnerships, estates, trusts, exempt organizations, and even complex global entities like controlled foreign corporations, CFCs, and 1050 corporations.
Wow. Okay. Lots of details there,
Mhm.
which really underscores something you mentioned earlier, the importance of staying current with IRS guidance.
Absolutely critical. I can't emphasize this enough. Tax law is incredibly dynamic. The IRS constantly updates its procedures, often in response to new legislation like TCJA or maybe emerging issues they see in audits. You must always check irs.gov and the Internal Revenue Bulletin, the IRB, for the latest procedures. Look for the current revenue procedures, like 2015-13, 2022-14, and 2023-1, as well as any new revenue rulings, notices, or regulations that might affect the change you're considering. Imagine missing out on a significant tax benefit, or worse, making an impermissible change, just because you used an outdated version of the Form 3115 instructions, or relied on guidance from 2 years ago that's now obsolete.
That would be painful.
It would. The IRS is constantly updating these, so keeping an eye on their published guidance isn't just good practice. It's essential for proactive tax planning and leveraging every advantage available. If you're not staying vigilant, you might literally be leaving money on the table or, opening yourself up to unnecessary scrutiny.
Okay, so let's bridge this to the bigger picture now. We've established what accounting methods are and how you change them using Form 3115. But how do these technical details really come alive when we consider major legislative shifts like the TCJA? It seems like it's not just about what changed in the law, but how those changes often demand a reevaluation of your internal accounting rhythms and maybe open up new planning opportunities using these very method changes.
That's exactly right. If we connect this to the broader landscape, the Tax Cuts and Jobs Act of 2017 was truly a major tax legislation. There's no understatement there. It comprehensively affected individuals, businesses, large and small, and even tax-exempt entities on a scale we hadn't seen in decades. Its broad nature meant that many existing tax planning strategies needed fundamental reevaluation, just thrown out the window sometimes. This, in turn, often pushed businesses to consider and often execute formal accounting method changes via Form 3115. The TCJA didn't just tweak tax rates, it fundamentally altered how and when certain income items are recognized and certain expense items are deducted.
The timing again.
Exactly. This directly dictates the optimal timing of income and expenses, a crucial component of tax planning, especially in our dynamic tax rate environment. TCJA was almost like hitting a reset button for many tax strategies.
Okay, let's dive into some specific TCJA provisions then. Let's explore their timing implications for businesses and how a strategic accounting method change using Form 315 and 4N can play a role. First up, the modification of net operating loss, or NOL, deduction under IRC Section 172. This was a big one. Before TCJA, businesses generally could carry back NOLs to offset income in prior years, often getting an immediate tax refund, and carry them forward for up to 20 years. A really powerful tool for smoothing out income. TCJA significantly changed these rules. It limited NOL deductions to 80% of taxable income in any given year, and crucially, it generally eliminated carrybacks for most taxpayers, allowing indefinite carryforwards instead.
The timing impact here is profound. This fundamentally shifts how businesses manage losses. Previously, you might accelerate losses into a year to get that quick refund via a carryback. But under TCJA, with the focus now on indefinite carryforwards and that 80% limitation, your strategy might shift dramatically. Imagine a construction company that uses the percentage of completion method for its long-term contracts. If they anticipate a significant NOL due to, say, project delays or cost overruns, they might explore filing a Form 3115 to change to an exempt contract method, if they qualify, of course. This could defer income recognition until the project completion.
Why would they do that?
Well, it could allow them to strategically manage their taxable income over several years to
Okay.
maximize the benefit of that NOL deduction against future profits. They could avoid losing part of the deduction to the 80% limitation in a low-profit year, or maybe push the deduction into a future year where they expect tax rates to be higher. It gives them control.
Interesting. What about the qualified business income, or QBI, deduction under Section 19A? That was another major piece of TCJA for smaller businesses and self-employed folks.
Right. Section 199A allows eligible self-employed individuals and small business owners to deduct up to 20% of their qualified business income. But it's subject to various limitations and thresholds based on taxable income, W-2 wages, and the unadjusted basis of qualified property. It gets complicated fast. Now, while claiming the QBI deduction isn't a direct accounting method change itself, the calculation, and especially those complex limitations and income thresholds, can heavily incentivize certain income and expense timing decisions.
Oh, so.
For example, a consulting firm that's on a cash or hybrid method might strategically decide to pay year-end bonuses in December instead of January, or maybe accelerate payments for office supplies and software licenses. Why? to ensure their taxable income falls below a specific threshold, which might allow them to maximize their QBI deduction for that year.
Ah, so they manage timing to optimize the deduction.
Exactly. Or, conversely, if pushing income over a certain threshold actually opens up a larger QBI deduction, due to how the limitations work, they might defer expenses into the next year. So while 199A itself isn't a Form 3115 trigger, it heavily influences the why behind timing decisions that could then be facilitated by other accounting method changes, like switching inventory methods or how they recognize advance payments.
Okay, next up, the limitation on business interest expense under Section 163J. This sounds like it directly impacts timing.
It does, significantly. This provision generally limits the deduction for business interest expense to 30% of adjusted taxable income, or ATI. ATI was basically EBITDA for tax purposes for a few years after TCJA, but then it switched to EBIT, which is a tighter calculation, making the limitation bite harder for some.
So you can't always deduct all your interest expense.
Not necessarily. For businesses that hit this 30% limitation, their excess interest expenses are effectively deferred. They become disallowed business interest expense that can be carried forward indefinitely. This directly impacts when a business can realize the tax benefit of its borrowing costs. Imagine a capital-intensive manufacturing business. They rely heavily on debt for expansion. If they're nearing that 30% limit, they might explore an accounting method change, maybe via Form 3115, to capitalize certain costs rather than expensing them immediately, perhaps through a change in their uniform capitalization, UNICAP method.
How would capitalizing help with the interest limit?
Because by capitalizing rather than immediately expensing, they increase their taxable income, their ATI. And a higher ATI means a higher 30% interest expense limitation threshold. So capitalizing some costs might allow them to deduct more of their current year's interest expense right now. It's a careful balancing act between managing expenses and maximizing current deductions.
Okay, that's clever. What else did TCJA throw into the mix regarding timing?
Another impactful one was the limitation on losses for taxpayers, other than corporations, often called the excess business loss limitation under Section 461 LO. This imposed a limitation on deductions for excess business losses for non-corporate taxpayers, so individuals, partners, S-corp, shareholders. It treats losses above a certain threshold, which is inflation adjusted each year. For example, it was $289,000 for single filers in 2024, double that for joint, as an NOL carry forward instead of allowing the full loss deduction in the current year.
So it forces a deferral of big losses.
Exactly. It transforms what would have been an immediate deduction into a future one. Consider a farming operation or maybe a real estate venture. These often experience significant losses in certain years due to weather, market conditions, or large upfront investments. If they see they're about to hit this excess business loss limitation, they might use an accounting method change to accelerate income recognition into the current year.
How could they do that?
Maybe by changing their method for handling advance payments or switching inventory valuation methods if applicable. The goal would be to generate more income now to absorb more of that potential loss immediately, rather than having it deferred under 461 time. Again, tax planning has to consider how to manage activities to avoid or minimize hitting this limit if an immediate deduction is preferred. Or, alternatively, plan for the future use of these deferred losses, always keeping an eye on anticipated future tax rates.
And one more TCJA provision that's all about timing. Opportunity zones and qualified opportunity funds under Sections 1400Z1 and 1400Z2.
Yes, this is a prime example of tax policy driving investment timing. Opportunity zones offer significant tax benefits for investing capital gains into economically distressed communities. This provision is entirely about deferring and potentially reducing capital gains tax liability. It directly influences the timing of when investors choose to recognize capital gains and when they reinvest those gains. It creates powerful incentives to align realization events with these investment opportunities.
Can you walk through how that works?
Sure. Imagine you realize a large capital gain from selling, say, highly appreciated stock in a year when capital gains rates are high. If you reinvest those gains into a qualified opportunity fund within 180 days, you can defer paying tax on that original gain until December 31st, 2026. And if you hold the opportunity fund investment for at least 5 years before that date, you might get a basis step up, reducing the original gain taxed. If you hold it for 10 years, any appreciation in the opportunity fund investment itself becomes completely tax-free.
Wow. So it's deferral plus potential exclusion.
Exactly. Well, setting up an opportunity fund isn't a Form 3115 method change itself. It's a masterclass in capital gain timing strategy. And that strategy might influence other accounting method decisions. Maybe make a change to accelerate deductions to free up cash for the opportunity zone investment, or manage income flows leading up to the capital gain realization. It's all interconnected.
It's really clear how these legislative changes create ripples, sometimes tsunamis, that directly impact the need for accounting method changes.
Absolutely. Yeah. And the IRS itself recognizes this direct link. Their own internal training materials explicitly include sections on TCJA inventory and accounting method changes, specifically for large businesses. This just demonstrates that these legislative shifts often necessitate formal accounting method changes, either to ensure you're complying with the new rules or, more proactively, to strategically leverage the new provisions for tax optimization. It's a very dynamic interplay.
And this is precisely where those DCNs, the designated automatic accounting method change numbers we talked about, become so valuable. They provide a structured, efficient way to make these shifts, often prompted or accelerated by legislative updates like TCJA. Rather than try to cover every single DCN, there are dozens. Let's maybe zoom in on a few categories that offer really profound opportunities for timing and tax benefits.
Good idea. Let's start with depreciation-related changes, which fall under Schedule E of Form 31 and 15. A great example directly tied to TCJA aftermath is DCN 244. This DCN addresses changes for qualified improvement property, QIP, placed in service after 2017.
QIP, that was the retail glitch, right?
Exactly. The infamous retail glitch. Initially, due to a drafting error in TCJA, QIP, which is generally interior improvements to non-residential buildings, was unintentionally excluded from eligibility for 100% bonus depreciation. This meant businesses had to depreciate these improvements over a lengthy 39 years, instead of taking a huge immediate deduction. It was a major problem, especially for restaurants and retailers. Congress later corrected this retroactively with the CARES Act. DCN 244 allows taxpayers to formally change their method of accounting for QIP to properly take advantage of that 100% bonus depreciation, or to otherwise correct how they were depreciating it under the old incorrect interpretation.
So this DCN lets you go back and fix it?
Essentially, yes. For open tax years or through a Section 481A adjustment, it means you can formally change your depreciation method now to capture those faster write-offs on those past QIP investments. Imagine a restaurant that did a big interior renovation back in 2018. This DCN could allow them to claim a significant immediate deduction they originally missed, potentially dramatically reducing their taxable income for that year, or creating a catch-up deduction now.
That's a powerful fix. What about other common areas, like repairs?
Right. The DCNs related to repair versus capitalization under Sections 162 and 263A are classic strategic timing decisions. Let's focus on DCN 184. This DCN allows you to change to deducting repair and maintenance costs immediately under Section 162, rather than capitalizing them as improvements under Section 263A. Consider a real estate developer managing a portfolio of commercial properties. Historically, they might have capitalized expenditures like roof repairs or replacing HVAC units, depreciating them over many years.
Spreading the deduction out?
Correct. But by switching their method using DCN 184, they can potentially get the full tax benefit for those repair and maintenance costs in the year the expense is incurred. This dramatically accelerates deductions and lowers current taxable income. It's particularly attractive when tax rates are high, or if you simply need to offset other income that year. It's a trade-off, of course, between building long-term asset value on the books and improving immediate cash flow through tax savings. And conversely, DCN 192 for capitalizing acquisition or production costs provides the path for the opposite change if deferring deductions makes more sense strategically. This choice significantly impacts your current year's taxable income and directly affects cash flow.
Okay, repairs are common. What about things like payroll? Can timing matter there too?
Oh, absolutely. Let's look at the timing of payroll and other liabilities under Section 461. DCN 45 and DCN 113 are incredibly powerful for certain businesses. These deal specifically with payroll tax liabilities. Think FICA, Social Security and Medicare, FET, federal unemployment, and state unemployment taxes. Imagine a manufacturing company. They pay their employees' wages right at the very end of December, but the associated employer payroll taxes aren't remitted until January of the next year.
Right. Common scenario.
If they meet the requirements of the recurring item exception, which generally means the liability is fixed, determinable, economically performed soon after year end, and is recurring in nature, these DCNs allow them to accelerate the deduction for those employer payroll tax liabilities into the current year, December, even though the payment itself happens in the following year, January.
So you get the deduction a year earlier?
Precisely. That's a direct acceleration of expenses, putting cash back in their pocket faster by lowering the current year's tax bill. Similarly, DCN 133 allows for strategic timing for deducting liabilities for bonuses, and DCN 42 covers employee medical benefits liabilities under similar principles. This kind of accelerated deduction can be a significant cash flow benefit, especially valuable if you anticipate higher tax rates in the future.
What about the other side income? Especially advance payments, which seem tricky.
Very tricky, but also full of opportunity thanks to TCJA and subsequent guidance. Under Income Recognition and Advance Payments, Section 451, and related to Schedule B of Form 3D-115, we have a suite of important DCNs, 242, 250, 252, 253, and 255. These cover changes related to the new applicable financial statement, AFS income inclusion rules brought in by TCJA, and also various deferral methods for advance payments. These DCNs are incredibly powerful for businesses receiving payments upfront. Think of a software as a service, SaaS company that collects annual subscription fees upfront in January for the whole year.
Yeah, lots of businesses do that.
Historically, for tax purposes, they might have had to recognize that entire payment as income in the year received, even though they earn it over the next 12 months. These new rules and DCNs, however, allow businesses with an AFS, like audited financials, to generally follow their book treatment, or for others, to defer recognition of certain advance payments for goods or services until the next tax year, or spread it under certain methods.
So they get the cash now, but pay tax later.
In many cases, yes. It directly influences when that income hits their books for tax purposes. The business has the cash in hand now, improving working capital, but the tax bill related to that cash is pushed out. For businesses with significant advance payments, think subscriptions, retainers, deposits, this is a massive boost to cash flow and a powerful income deferral tool, especially useful if you foresee lower tax rates in the future or need to manage taxable income to stay below certain thresholds, like for QBI.
Okay, one more category: inventory. TCJA seemed to simplify things for small businesses here.
It really did. For inventory methods, under Sections 471 and 472 relating to Schedule CD, DCNs 235, 262, and 263 are particularly beneficial for small businesses. These DCNs offer incredible flexibility, especially post-TCJA. DCN 235, for instance, allows small businesses, those meeting that gross receipts test we keep mentioning, to treat their inventory as non-incidental materials and supplies. NIMS.
NIMS instead of inventory. What does that mean practically?
For many small businesses, traditional inventory accounting can be complex. You have to track cost of goods sold, figure out valuation methods like FIFO or LIFO. It's a hassle. By treating inventory as NIMS under DCN 235, the costs are generally deducted when the items are used or consumed in the business, rather than having to wait until the finished inventory item is actually sold. Imagine a small custom furniture maker. Instead of waiting until a specific table is sold to deduct the cost of the lumber used to make it, by treating that lumber as NIMS, they could potentially deduct its cost when it's pulled from the rack and put into production.
Ah, so it speeds up the deduction for the raw materials.
Often, yes. It can significantly accelerate deductions for inventory costs, which is a substantial tax advantage, especially when you need to offset current income or manage fluctuating inventory levels without complex tracking. DCNs 262 and 263 relate to other small business inventory exceptions, including allowing them to conform their inventory method to their applicable financial statement, if they have one, further simplifying accounting and potentially impacting timing.
This is incredibly useful detail on specific changes, but you mentioned a caveat about relying on the DCN list.
Yes, it's crucial to remember that while the list of DCNs published in the Form 3D-115 instructions is an invaluable resource for identifying potential changes, it's primarily for informational purposes. You must always rely on the specific underlying published guidance like Revenue Procedure 2022-14 for automatic changes or other specific RevProcs or notices. The underlying authority for any given DCN can become obsolete. It can be superseded by newer guidance. This means a change might no longer be permissible under that specific DCN, or the procedures might have changed.
So always check the source document.
Always. Staying vigilant about the latest IRS pronouncements is paramount. It's a dynamic landscape, and relying on outdated information can lead to missed opportunities or worse, compliance issues and disallowed changes.
Okay, so let's say you've identified a change, filed Form 30145, and it's approved. You mentioned there's a necessary catch-up mechanism. This is the Section 481A adjustment. It sounds technical, but you stress it's incredibly important because it dictates when the tax impact of your method change is truly felt. Can you break that down?
Absolutely. The Section 481A adjustment serves a critical purpose. It ensures that your taxable income isn't distorted by the mere fact that you changed accounting methods. It prevents items of income or expense from being duplicated or completely omitted due to the switch. It's designed essentially to bring the taxpayer to a neutral position, as if the new method had always been used from the very beginning for all the years the old method was in place.
How is it calculated?
It's the net amount of all the adjustments, increases, and decreases to income that would have been required if the new method had been in effect for all prior years that the prior method was used. Let's use that example from the source material again. A manufacturing business changes its inventory method to stop capitalizing certain indirect costs, like salary bonuses for production supervisors, which they previously had to capitalize under UNICAP rules. If their beginning inventory as of January 1st, 2022, computed under the old method was $100,000, but under the new method, without those capitalized bonuses, it would only be $92,000. Then the decrease in beginning inventory is $8,000. This $8,000 represents the accumulated overcapitalized costs from prior years that now need to be accounted for. This is a negative Section 481A adjustment.
Okay, negative $8,000. What does that mean for their tax return this year?
This is where the timing becomes crucial for planning. For a negative adjustment like our $8,000 example, which is almost always a tax benefit because it results in an additional deduction, the adjustment period is typically one tax year, specifically the year of the change.
So they get an immediate $8,000 deduction.
Correct. That $8,000 deduction hits their taxable income immediately in the year they make the change. This can mean a significant reduction in current year tax liability and a corresponding, very welcome cash infusion through tax savings.
Nice. What if the adjustment is positive, meaning the change increases income?
Good question. For a positive adjustment, which increases your taxable income, this might happen if, say, you were previously undercapitalizing costs and now have to add them back. The adjustment period is generally spread over 4 tax years, starting with the year of change.
Spread over 4 years. Why?
This spreading helps to mitigate the immediate tax impact. It prevents a large single-year tax shock that could potentially push you into a higher tax bracket or create an unexpected large tax bill you weren't prepared for. It smooths the transition.
Are there any exceptions to that 4-year spread for positive adjustments?
Yes, there are a couple of important strategic options. If the total positive Section 481A adjustment is less than $50,000, the applicant can actually elect a 1-year adjustment period instead of spreading it over 4 years.
Why would you choose to take the hit all at once?
Well, it could be very beneficial if you anticipate being in an unusually low tax bracket in the year of change, perhaps due to other large deductions, or maybe it was just a down year for the business. You could absorb that extra income with less tax consequence than if you spread it into potentially higher tax future years. Additionally, a 1-year adjustment period can also be elected in certain eligible acquisition transactions, which provides some planning flexibility in M&A context. So understanding the 481A adjustment, whether it's negative or positive, and how long the adjustment period is absolutely paramount. It dictates when the economic impact of your method change is actually felt on your tax returns and your cash flow.
Okay, so the 481A adjustment handles the past catch-up fairly. Once that's done and the change is approved, what kind of certainty do you gain going forward? This leads us to a concept that, frankly, sounds like music to many taxpayers' ears. Audit protection. That sounds incredibly powerful, almost like a superpower in the tax world. But is there a catch? Are there situations where this protection might not apply, or maybe where it's surprisingly limited?
That's an excellent question, and it really gets to the heart of risk management in tax planning. Generally speaking, when an accounting method change is granted by the IRS, audit protection does apply. What it means is that audit protection generally applies to tax years prior to the year of change, but only for the specific item whose accounting method was changed.
So for that specific issue, the IRS won't come back and challenge how you did it in earlier years.
That's the general rule, yes. It's a huge benefit. It means the IRS generally won't challenge the prior year treatment of that specific item, giving you peace of mind and reducing your audit exposure for that particular issue.
Okay, but you said general rule. What are the exceptions? Where does audit protection not apply?
Right. There are important exceptions, and you need to be aware of them. They're outlined in Section 8.02 of Revenue Procedure 2015-13. For instance, audit protection might not apply if the method you're changing from wasn't really before the director. Maybe it was clearly permissible all along, or you only adopted that questionable method after the tax years the IRS might be looking at. The idea is protection applies to issues the IRS could have challenged. It also might not apply if the change results in a negative Section 481A adjustment, a benefit to you, That would have also been negative if calculated in the earlier examined years. The IRS's thinking here might be, well, we would have found this adjustment anyway if we audited those years.
Interesting. So it's not a blanket shield.
Not at all. Furthermore, certain specific automatic changes explicitly do not receive audit protection. A key example is DCN 17, which relates to changing the treatment of research and experimental expenditures under Section 174. No audit protection there. Similarly, changes made within a small business inventory method under Section 471C using DCN 262 also do not receive audit protection. Knowing this isn't just about reading the fine print, it's critical for calculating your risk exposure. You might decide to pursue a slightly less aggressive change that does get audit protection, or if you go for the unprotected change, you need to be prepared to defend your prior year's position with very robust documentation.
What about if you're already under audit when you want to make a change?
That's a whole different ballgame. The rules change significantly if the applicant is already under examination by the IRS, or if the specific accounting method you're trying to change is already an issue under consideration by an IRS examining agent, the IRS appeals office, or even a federal court.
What do those terms mean exactly? Under examination and issue under consideration.
Under examination generally means the IRS has contacted you formally to schedule or conduct an examination of your tax return for a specific year. An issue under consideration is more specific. It typically means the examining agent has given you written notification, like in an information document request, IDR, specifically citing that accounting method or item as something they are reviewing or proposing an adjustment for. In these scenarios, audit protection for that specific issue is significantly curtailed or often completely non-existent because the IRS is already actively looking at it. You generally can't file for an automatic change for an issue under consideration, and non-automatic changes become much more complex. And, just to add another layer, special different rules regarding audit protection also apply for controlled foreign corporations, CFCs, and 1,050 corporations, reflecting the complexities of international tax.
So the takeaway here is that choosing an accounting method change isn't just about maximizing the immediate tax benefit.
Exactly. It's also very much about managing your audit risk. Understanding when audit protection applies, and perhaps more importantly, when it doesn't, is a crucial part of the strategic planning process. It's about not just optimizing your tax position today, but also securing it against future challenges, which, frankly, can be just as valuable as the tax savings themselves.
And that highlights the importance of clear communication if you are under examination when you file Form 3115.
Absolutely vital. If you answer yes to the question about being under examination on Form 3115, you're required to provide a copy of that filed Form 3115 to the specific examining agent or appeals officer handling your case. This needs to be done no later than the date you timely file the form with the IRS Processing Center. This transparency is key to navigating the process smoothly and avoiding any miscommunications or procedural footfalls that could jeopardize your change request or just increase scrutiny unnecessarily.
Okay, this has been incredibly detailed on the mechanics.
Right.
Now let's really bring it home with practical applications. We've talked about the why, TCJA, right changes, and the how, Form 3115, DCN's 481A, audit protection. But how do specific accounting method changes give businesses, especially smaller ones, real flexibility to manage their income and expenses, particularly with those shifting tax rates always looming in the background? This is where the strategy really comes into play.
Right. This is where we tie it all together for strategic planning. And many of these strategies are particularly powerful for the small to medium-sized businesses that often have the most to gain from this kind of flexibility. Let's elaborate on some of those specific DCNs and schedules we touched on earlier, really focusing on their distinct tax benefits and their powerful timing implications.
Let's start with the big one for small businesses, the overall cash method.
Yes. Covered by DCN 233, DCN 259, and detailed in Schedule A of the form. This is truly a cornerstone for tax planning for smaller entities. For qualifying applicants generally, those with average annual gross receipts of $25 million or less, which, as we noted, was inflation adjusted to $27 million for 2022, you can change to the overall cash method of accounting. Or, alternatively, you can adopt a hybrid method, using an accrual method just for inventory purchases and sales if inventory is significant, but using the cash method for all other income and expenses.
And the benefit of cash method again.
Immense control over timing. The cash method allows you to generally defer recognizing income until you actually receive the cash. And you can often accelerate deductions by paying expenses before year end. Imagine a freelance graphic designer again. They finished a big project in December, but deliberately don't invoice until January 1st. Under cash method, boom, that income is deferred to the next tax year. Or, if they want to lower this year's income, maybe they prepay their estimated state taxes for the fourth quarter in December, or pay their office rent for January early on December 31st. They get that deduction a full year earlier than if they paid January 1st.
So you can actively manage your income bracket year to year.
Precisely. This flexibility is particularly valuable when you're anticipating changes in tax rates. You might accelerate deductions into a year, will have higher rates to maximize their value, or defer income into a year you expect rates to be lower, minimizing the tax bite. It's a direct, intuitive way to manage your taxable income flow.
Okay, what about UNICAP? You mentioned an exception there too, DCN 234.
Yes, the Uniform Capitalization, UNICAP, exception for small businesses, DCN 234. This is for businesses meeting that same gross receipts threshold, 27 hours for 2022. It allows them to change from having to capitalize certain direct and indirect costs under the complex rules of Section 263A UNICAP to no longer having to do so.
What kind of costs are we talking about?
UNICAP requires producers and certain resellers to capitalize not just direct costs like materials and labor, but also a portion of indirect costs like factory overhead, administrative support for production, into the cost of inventory or self-constructed assets. These costs are then recovered slowly, either through cost of goods sold when inventory sells or through depreciation. DCN 234 lets eligible small businesses stop doing this. They can move from capitalizing these indirect costs to immediately deducting them in the year incurred.
So, faster deductions again?
Much faster. Think of a small craft brewery. Under UNICAP, they might have had to capitalize a portion of the brewery manager's salary or the utilities for the production area into the cost of the beer. By changing their method via DCN 234, they can just deduct those costs as regular operating expenses when incurred. It's a direct acceleration of expenses, boosting current year deductions and freeing up cash flow that would otherwise be tied up, waiting to be recovered. This is especially impactful for manufacturing or large resale businesses that would otherwise have significant capitalized costs dragging down their immediate deductions. It's a strategic choice that can immediately improve profitability and working capital.
And the inventory exceptions, DCNs 235, 262, 263, how do they help with timing?
The inventory exceptions for small businesses are hugely beneficial for simplification and timing. Again, for those meeting the gross receipts test. These allow eligible small businesses to simplify their inventory accounting dramatically. One option, under DCN 235, is treating inventory as non-incidental materials and supplies, NIMS. We talked about this briefly. Instead of complex inventory valuation and COGS calculations, treating items as NIMS generally means their costs are deducted when they are used or consumed in the business, rather than waiting for the final product to be sold.
Like the jewelry maker example.
Exactly. The cost of the gold or gems might be deductible when they start making the piece, not when it's sold months later. This often accelerates deductions for the costs associated with inventory, which is a big tax advantage, especially helpful for managing cash flow or offsetting current income. DCNs 262 and 263 provide other simplifying options, like conforming your inventory accounting method to the one you use on your applicable financial statement, AFS, if you have one. This reduces bookkeeping burdens and can also impact the timing of deductions depending on your AFS method.
What about specific industries? Construction came up earlier, DCN 236.
Yes, the long-term contract exception for small businesses, DCN 236. This is tailored for the construction industry. Again, for those meeting the small business gross receipts threshold. It allows eligible small businesses with certain exempt long-term construction contracts. Generally, contracts expected to be completed within 2 years, performed by a taxpayer meeting the gross receipts test, to change from using the percentage of completion method, PCM, to using an exempt contract accounting method, like the completed contract method.
PCM versus completed contract. What's the timing difference?
Under PCM, a contractor has to recognize income proportionally as costs are incurred throughout the life of the project. So revenue gets recognized each year the project is ongoing. Under the completed contract method, however, the contractor generally defers recognizing all the gross income and deducting all the allocable contract costs until the year the contract is fully completed and accepted.
So you push all the profit recognition to the very end.
Essentially, yes, for tax purposes. That's a direct and potentially massive income deferral strategy. Highly beneficial if you're in a rising tax rate environment, or if you expect losses from other activities in the year of completion that can offset the contract income. It provides remarkable control over when large chunks of project-based income hit your tax return.
And those advanced payment rules, again, DCNs 242, 250, etc., how strategic can you get with those?
The DCNs related to advance payments and AFS income inclusion are incredibly versatile. These cover a suite of changes allowing businesses receiving payments upfront to potentially defer income or use cost offset methods, often aligning tax timing more closely with financial reporting, especially if they have an applicable financial statement. Think about that online course provider selling annual subscriptions, receiving $1,200 on January 1st. Under the old rules, maybe all $1,200 was income in year one. With the new rules and these DCNs, if they have an AFS that recognizes revenue monthly, $100 bonus, they might be able to follow that for tax too. Or even without an AFS, they might qualify for a one-year deferral, meaning they recognize the portion earned in year one, say $1,200, and defer the unearned portion, $0 in this specific example, but imagine a multi-year contract, to year two.
So you get the cash flow benefit immediately, but deferred the tax liability.
Precisely. It means cash in hand now, but the tax bill associated with that cash is pushed out. For businesses with significant advance payments, subscriptions, retainers, gift cards, software licenses, this is a massive boost to working capital management and a powerful income deferral tool, especially useful if you foresee lower tax rates in the future or need to manage current taxable income carefully to stay below certain limitation thresholds.
And let's revisit that common one. Deducting repair and maintenance costs, DCN 184. How does that play out strategically?
This is frequently used and powerful because it's about immediate expensing versus slow capitalization. DCN 184 allows a change from capitalizing costs considered improvements under Section 263A to deducting costs considered repairs and maintenance under Section 162. Think about that logistics company with a fleet of delivery trucks. They have significant engine overhauls. Historically, maybe they capitalized these costs, adding them to the truck's basis and depreciating them over 5 or 7 years. By using DCN 184, guided by the tangible property regulations, they might determine these overhauls qualify as deductible repairs. If so, they get the full deduction for these substantial costs in the year they incur them, rather than spreading it out.
A much bigger hit to taxable income up front.
Exactly. It dramatically accelerates deductions, lowers your current taxable income significantly. Very attractive when tax rates are high, or you need to offset an unusually high income year, or just want to improve immediate cash flow. It makes it a highly attractive method change for many asset-heavy businesses.
It really seems like that small business threshold, that $27 million in gross receipts for 2022, is a key number here.
It absolutely is. It's worth reiterating that inflation-adjusted amount. That threshold isn't just some random number. It is effectively the gateway to many of these simplified and advantageous automatic tax accounting changes we've discussed: cash method, unicap exception, inventory exceptions, long-term contracts. For businesses that qualify by staying under that threshold, it unlocks a whole treasure trove of tax planning flexibility that can genuinely streamline their operations and optimize their tax position. It's truly a lifeline for managing the complexities of growth under a dynamic tax code.
Listening to all this, it's clear these aren't just obscure rules buried in the tax code. They are actual strategic opportunities. Opportunities that can save businesses real money, provide crucial cash flow, especially when the tax landscape shifts as dramatically as it did with the TCJA. The ability to consciously time your income and expenses using these very specific IRS procedures and guidelines is a remarkable level of control. Control that I suspect many taxpayers don't even realize they possess. It really shifts the perspective from reactive compliance to proactive financial management. So wrapping up our deep dive today, we've really journeyed through the world of accounting method changes. From the foundational Form 3115 through the profound impacts of the Tax Cuts and Jobs Act, we've seen how understanding the difference between automatic and non-automatic procedures, how to navigate those Section 481 adjustments, and how to leverage specific DCNs can give you a remarkable level of control over the timing of your income and expenses. This isn't just about compliance anymore, it's about strategic financial maneuvering, giving you the power to optimize your tax position in a world where the rules seem to be constantly shifting.
That's exactly right. Effective tax planning isn't just about reacting to the latest tax forms that show up or, waiting until April 15th to deal with your obligations. It's really about proactively understanding how legislative shifts, like the TCJA, fundamentally open doors for strategic accounting method changes. These changes allow you to optimize your tax position, whether that means accelerating deductions into a high tax year to maximize their immediate value, or maybe deferring income when you anticipate rates are set to drop, preserving more of your hard-earned revenue. It's about playing the long game, really, with foresight, continuously adapting your financial strategy to the tax environment you find yourself in.
So, as tax rates and regulations inevitably continue to evolve, maybe here's a final thought for you, our listener, to ponder. What single accounting method change could you potentially implement right now using these very procedures we've discussed today that would best position your business or personal finances for whatever the next wave of legislative change might bring? The more you understand these powerful tools like Form 3115 and the strategies around it, the more empowered you become in your financial journey. Keep digging, keep learning, and definitely keep asking those what if questions about your tax planning.